Good afternoon, everyone. Thanks for being here for this panel, How to Restart the Private Market for Mortgage Credit. Let me begin by just very briefly introducing our panelists today. First, I am Ed DeMarco. I'm a senior fellow in residence here at the Milken Institute. To my immediate left is Congressman Ed Royce from right nearby here in California. Congressman Royce is the chairman of the House Foreign Affairs Committee. He is also a very active and senior member of the House Financial Services Committee. To his left is Brian Whalen. Brian is the Group Managing Director in the area of U.S. fixed income at TCW. To my right is Stan Curlin. Stan founded and is the chairman and CEO of PennyMac Financial Services. And to Stan's right is Lindsay Johnson, the president and executive director of U.S. Mortgage Insurers. So I'd like to thank my panelists for being with us this afternoon. So, a market for mortgage credit. What does that mean? What does it mean to restart it? Right? So, the single-family mortgage market in the United States is about a $10 trillion credit market. And today, in this market, roughly 3 out of every 4 mortgages that gets originated has credit support coming from the American taxpayer, either through the guarantee programs of the FHA and the Veterans Administration or Rural Housing, or through loans that are sold into the secondary market to be securitized by Fannie Mae and Freddie Mac, Fannie Mae and Freddie Mac operating in U.S. government conservatorships supported by the American taxpayer. So the default risk on a tremendous portion of the U.S. mortgage market is currently being supported by taxpayers. And so the basic issue before us is how do we gradually move this burden away from the American taxpayer and back into private capital markets? Where are we in that journey? What are the things that are going on right now are some of the questions that our panel is going to tackle today. Let me just begin in framing this. There have been certain initiatives to restart private markets. The Federal Housing Finance Agency, which is the conservator of Fannie Mae and Freddie Mac, has over the last several years directed Fannie and Freddie to start to sell off to market participants a portion of the credit risk that they retain. So let's just level set on what that means. Fannie Mae and Freddie Mac securitize, that is, they purchase, they bundle into pools and then sell mortgage-backed securities to investors, an aggregate of about $5 trillion of mortgage-backed securities. So that's half of the $10 trillion U.S. mortgage market. But when they gather these mortgages, when they buy them, pool them, and package them in the securities, the interest rate risk on those mortgages travels with the mortgage-backed securities, so the investors hold that. But the credit risk, the risk that if the borrower defaults, who's covering that, all stays within Fannie Mae and Freddie Mac. So half of the mortgage credit risk in the United States is sitting on the balance sheets of Fannie Mae and Freddie Mac. And certainly that contributed to why they're in conservatorship today. But over the last few years, FHFA has been working with Fannie and Freddie to begin selling off portions of that to the private market. So we're going to take some time exploring that. But that's not the only thing being done. The other things being done in this space is to create a lot more standardization with regard to data and with regard to disclosures. All is developmental work to develop a more active trading market for mortgage credit. One other thing I'll say just as a context setter is prior to the financial crisis, we also had a great deal of securitization taking place in what was called the private label market. That is mortgages that were entirely originated, securitized outside of any government or government-sponsored enterprise program. When the financial crisis hit, that market evaporated and has been very, very slow to return. The Treasury Department and the Structured Finance Industry Group have been working hard to get that restarted, and we'll touch on that a little later today. But our main focus will be on the GSE market since it is such a big part of the overall U.S. mortgage market. So we'll start with level setting on, is this even the right question? do we have a consensus on the policy goal of shifting mortgage credit risk away from taxpayers and really trying to work on restarting a private market to price and manage the credit risk inherent in these mortgages? And before I turn to Congressman Royce to provide some perspective on that, I would just note for those of you that were at lunch today, or even if you weren't, current Treasury Secretary Jack Lew was interviewed as part of the lunch presentation, and in that he was asked about this credit risk transfer process and the progress being made, and he was quite clear in saying that he thought this was a very important development and that the administration really wanted to see this continue. So with that, let me turn it over to you, Congressman Royce, and invite you to give us some perspective on this.
Well, thank you, Ed. I think just in responding to your question of Jack Lew previously, I brought this up to Jack Lew when he was before our committee, and pushed him in this regard as well. And it is true that we are moving very slowly. It's been a long time coming, but to a consensus. And that consensus is, yes, to move forward in laying off more of this risk, the credit risk. And if we look at how we got here for a moment, part of our problem with respect to the GSEs was that we had a system of private gain but public losses. And clearly the moral hazard connected to that led to a situation where, without being able to adequately regulate this, and in 2003, I had legislation to try to bring the GSEs, all the GSEs, including the Federal Home Loan Bank, under one regulator in order to try to end some of the practices that were increasing the risk, especially the over-leverage, which reached 100 to 1. In 2005, on the floor of the House, I was able to get an initiative to attempt to deleverage these portfolios, or to give the regulatory community the ability to control them for systemic risk. And at that point in time, the debate was, systemic risk is a theoretical term. How do we, does that even really have meaning? Was one of the members said, we're ready to roll the dice a little bit on the risk in order to, give everybody an opportunity here. The follow-on to that was that the collapse of the housing market, because the regulatory community really could not step in and control this risk, also affected, of course, the wider financial services market. And so going forward, we've reached the point now where Democrats, Republicans are looking at initiatives like the ones that are being undertaken and encouraging this. And we think that this concept of, well, creating a common securitization platform that is used by everyone, not just Fannie and Freddie, and the concept of more credit risk transfer will do so much to move away from the moral hazard created. And I will just remind folks that still the portfolios are very high at Fannie and Freddie. And so if you're still got a third of a trillion portfolio there, and we're looking at problems today with Freddie in terms of the forecasts, the best way forward is to get the market and private capital, give them more space to come in and take off some of that, more and more of that risk. Good.
Well, let's take a look a little deeper then at these credit risk transfers and what this means for market participants and where we are today. So if we could have the first slide. What this shows is the volume of credit risk transfers that have been done by Fannie Mae and Freddie Mac since the program was initiated in 2013. So each chart for the years is showing the billions of dollars of unpaid principal balance of mortgages that have been subject to credit risk transfer. And in a minute, we'll go through what that means. As you see, we started with a few transactions in 2013, a big jump up in 2014, and some continued growth in 2015. If we go to the next slide, we can start to look at a couple of the structures that have been used. This has been done in several different ways. The initial credit risk transfer structures went by the name of Connecticut Avenue Security for Fannie Mae and Stacker for Freddie Mac. And the concept here is really fairly simple. Rather than issuing, so Fannie and Freddie are still issuing their normal mortgage-backed securities, but these Stacker and CAS securities are debt instruments that are issued, and the principal repayment on these debt securities is a function of the performance of a reference pool of mortgages. So say, for example, all the mortgages between 60 and 80% LTV that Fannie Mae purchases in a given quarter, that's the reference pool. And so the credit performance of that reference pool is what determines the repayment to these debt investors. What you see on the far right of that stack is an inverse waterfall of how the losses are assigned. At the bottom, first, Fannie or Freddie would retain the initial losses, credit losses, and then there were two classes, Class M2, Class M1 is denoted here, that were next in the waterfall for absorbing losses if the credit performance of the reference pool exhausted the first loss position of Fannie and Freddie. So this is just another way of saying, okay, this is how the market participants were absorbing a portion of the credit losses if the defaults on this particular vintage of group of mortgages in the reference pool exceeded limits. Now, Fannie and Freddie are retaining some share in the Stacker and CAS deals, so they are also sharing in these losses along with investors. And then the big block at the top of this inverse waterfall, that's showing that Fannie or Freddie retained all the risk after this intermediate level. If we go to the next slide, another type of execution has been reinsurance. So in the reinsurance, you see on the far left, that could be Fannie or Freddie. It's a mortgage-backed security issuance. So they retain the first 1% of loss in this case. And then for any losses between 1% and 3% of the unpaid principal balance, there's a reinsurance contract with private reinsurers that are covering some of that risk. So this is a way that they are laying off that credit risk to the reinsurance market, and then they're retaining all the losses beyond that. Okay, if we can go to the next slide. So who's holding this? Who are the investors, the private investors that are purchasing this? Well, as you can see, asset managers constitute a little more than 50% of it, hedge funds 31%, so there's the bulk of it right there, asset management firms and hedge funds. Interestingly, one group I want to point out at the top is the REITs, the real estate investment trusts, only holding 2%, although one might think that they are a natural holder of these kinds of instruments. Well, there's some tax and regulatory and statutory issues right now that limit their participation in this market, and in the policy realm, redoing that is one of the policy questions that's on the table. All right, so that's a basic introduction to a couple of the transactions that have been done. But I want to turn now to Stan Curlin, because Stan, you and your firm, like a few others, have used yet another form of credit risk transfer with Fannie and Freddie. And so if you could describe your views on credit risk transfer generally, tell us a bit about the particular structures you've done, and give us some information about the economics of this and the investment objectives for a firm like yours.
Sure. Let me just start out with very briefly trying to give you a sense of what PennyMac does as an originator and how we participate in the mortgage banking enterprise. And it'll, I think, add to the dimension of people understanding how do you bring capital to bear in the mortgage market and around the capital that's required to transfer credit risk. So we are a mortgage enterprise. We built the company from scratch and starting in 2008 post the financial crisis, and it was very important to attract capital to create something that was legacy free, that didn't have all of the issues that would really plague the mortgage banking industry for practically 9 years now. So we created basically a brand new originator and servicer of mortgage loans, and that is PennyMac Financial Services, and it's of considerable size. It's the third largest aggregator of mortgage loans in the country, behind Wells Fargo and Chase. So it's the largest non-bank company, and it's a very large servicer, 10th largest servicer, about $165 billion of mortgages that we service. We also have another entity that is public as well, which is called, which is a REIT, PennyMac Mortgage Investment Trust. And so in the process of originating and aggregating mortgages, there are investments that come out of that, or opportunities unique to mortgage banking. The one is is credit risk, which, in the past, when you had private label securities, that took place in the form of subordinate interest in the mortgage-backed securities that were created, or mortgage servicing rights, which are a very critical part of the capital and dynamics around mortgages. So that's the company. It's sizable, and we basically started with a premise of how can we create an entity for the reemergence of the mortgage market that would bring capital to bear. And as you remember, the first initiatives that were talked about were aligning the interests of originators and servicers and requiring that there be capital alignment. And so we worked very closely, and I think there is great progress that is being made with Fannie and Freddie on how do you transfer credit risks, and and FHFA has, I think, led the charge to make these initiatives happen. And I think they're to a great extent, these things are very real. We have in our structure, you mentioned the REIT issues. We did address those issues in our structure so that we do end up with REIT eligible assets. I think at Stacker and CAS are basically not qualified assets. On this slide, that's I think probably 5, right? This is just to maybe give a little sense of what do we do as a major aggregator. There are many small, mid-sized mortgage lenders, and they don't have the capital either to invest in mortgage servicing rights, or they don't have the disciplines and the expertise to operate in terms of securitizing and managing interest rate risk that's required. And so we act as an aggregator. They're selling loans to us, and as Ed was describing, eventually these loans are getting to Fannie and Freddie in what, we're first buying these loans from the lenders, and we're doing significant diligence and review of these mortgages to make sure that they comply with all of the required standards. And then they're, in essence, a way to think of it is swapped these loans for the securities, and we deliver securities into the market. Aggregator, the loans that go through smaller lenders, it's about 30% of the market, and we play, again, a very significant role in that aggregation. But one of the things that's critical, or that we think is important, is that we create very high quality mortgages, and we expend significant capital in diligencing these mortgages, and we also service the mortgages. So we feel like we have this aligned interest, so we should be willing to invest the capital to take the first loss, should there be a loss. And the loss in a first loss piece is very significant. It's probably something in the neighborhood of 10 times the the size of the subordinate piece or the credit risk transfer in terms of what we invest is, 10 times the expected loss cumulative loss that you would have in normal circumstances. So if we flip to the next slide, just to put this together for you in terms of, what's a very simple view of what happens in credit risk transfer is, again, we're acting as an aggregator, but we set up another entity, which is a special purpose vehicle where this vehicle we're put in cash, typically starts at around 3.5% of the outstanding principal balance of the mortgages. And for that, we're going to receive from Fannie Mae part of the guarantee fee. And that part of the guarantee fee is, in essence, the capital or the return that we need on the capital that is locked in the SPV, and the capital locked in the SPV is there to meet the needs of should there be a credit loss. And so this is, a very sound approach to creating capital. It has to have return, obviously, for us to attract more and more capital to meet this credit risk. And it is working. We have, for example, today we've done some $7 billion of loans that we've put through this process. In fact, we put all of our Fannie Mae eligible loans for CRT are being created in a structure, and we continue to do this. Now, one of the issues in creating capital is that it's stable, and we heard a lot about this at the lunch about what's happening with credit spreads. And credit spreads earlier this year widened out dramatically, having nothing to do with mortgages. It had to do with the oil issues and defaults on debt related to oil, and that widened out credit as it relates to mortgages, and it created a problem in stacker and CAS structures, whereas in our structure, we've committed capital based on negotiated transaction with Fannie Mae, based on our return requirements and estimated performance of the mortgages, but we've committed that for several quarters in advance, so there's no disruption in the market. If credit spreads stay wide, we'll renegotiate the next transaction. So that's, I don't want to take too much time from the panel, but that's how a mortgage, I think, lender of the future participates in this. I think it's extremely viable that there are enormous amounts of capital can be brought to bear in this manner, and I'm not suggesting this is the only way that credit risk transfer can be done, but it's one of the ways. And what's exciting for us is that we're aligned. We produce more for our shareholders if the loans perform, if they're high quality, and then if they're servicing issues, we can also influence the performance of those loans and future losses by the activities that we initiate within the servicing. So it is very much, in line with, I think, original thinking, which was, let's get the originators and servicers to have a long-term vested interest in the performance of their loans.
Yeah. Thank you, Stan. I think that's really helpful, and it does raise an important point. I mean, relative to sort of, let's think even pre-crisis, a loan originator delivers mortgages to Fannie Mae and Freddie Mac. If you've got two originators and one's producing more high-quality credit than the other, there was no differentiation. You didn't get a benefit as a loan originator for producing better credit. And the kind of transactions that you're talking about, it's not just your firm, but all the small and mid-sized lenders that are selling through you, that there's an opportunity here to get an economic benefit for producing sounder quality loans. Well, Lindsay, let me turn to you, because this is, I mean, and we're talking about bringing private capital back in, but one source of private capital that never left, ran into a few troubles, but has always been there, has been the mortgage insurers. And there's been some pretty fundamental changes with regard to mortgage insurance over the last several years. So why don't you tell us some about that?
Sure. So mortgage insurance, I mean, at its core, I mean, we were the first layer of credit protection in the event that there's going to be a loss and the borrower is unable to repay, and there's not enough equity in the home to cover the amount that's owed. So mortgage insurance has actually kind of shifted, and we've moved away from what we would refer to as charter coverage, where the borrower doesn't have 20% to put down, so they make up the remainder in mortgage insurance, to what we refer to as standard cover, which is more actuarial based. It's the GSE set these new requirements, and mortgage insurance ranges from 10% all the way to 35% for a high LTV loan. So mortgage insurance really does operate in that affordability space, helping individuals with low down payments have access to mortgage finance credit, while at the same time, protecting the lenders and the GSEs. We've helped millions of individuals become homeowners because of this. So one of the things that Ed alluded to was the fact that, similar to the rest of the financial service industry has had to really enhance their capital and their relationships with the GSEs, mortgage insurers had to enhance our capital requirements. And so USMI members all went through a very rigorous set of new capital requirements called PMIERs, or the Private Mortgage Insurance Eligibility Requirements. These were set into place by the GSEs, and it basically took mortgage insurance capital from roughly 4% risk in force to somewhere between 7 and 8% risk in force. So basically doubled our capital. We also enhanced our master policy agreements, and these are sort of, I liken them to lender's reps and warrants, and it gives much greater clarity in terms of when and how a mortgage insurer is going to pay a claim. It's obviously very important for us to be good counterparties to the lender community as well as to the GSEs. Mortgage insurers also raised over $9 billion in new capital during the crisis, so we've demonstrated that if there's additional demand for mortgage insurance, mortgage insurers have ample capital and the ability to raise additional capital to meet that demand. So one of the things, as we sort of look out across the horizon, and various proposals have come up, legislative and otherwise, focus on getting more private capital into the system. And mortgage insurers, one of the questions, the challenges of those various proposals has been, who can take on this credit risk? Who can price credit risk? Who can hold credit risk? And who's got the capital to support that position? We look at that and we say, and probably similar to you guys, and we say, that's what we do. That's what we do every day. We are in the first loss position and allow the GSEs to be in the second loss position. One of the easiest ways to insert more private capital into the system is to allow for mortgage insurers to provide deeper cover. And there's actually a slide, a bar chart that you'll see in just a moment, that it really, deeper cover is basically what it sounds like. So right now, in the above 80 LTV space, mortgage insurance covers down from between 62 to 75% of the value of the loan. We're saying, why not just take mortgage insurance down to 50% of the value of the loan? So that, one more bar chart that will kind of demonstrate this. So that a home value actually has to decrease by 50% before the GSE ever experiences a loss. We can do this today without legislation. This is easy for lenders to implement. So we met with a number of stakeholder industry groups, regulators, policymakers, and the like, and they basically said, well, go out and tell us what that looks like. Tell us the economics. So we hired one of the largest actuarial firms. We commissioned them to do a study to tell us what we would need to charge in additional mortgage insurance premiums to cover that additional layer of loss. And the study basically concluded that mortgage insurers can do this while still ensuring a broad range of creditworthy borrowers that's not a detriment to the borrower in terms of pricing, and it more than doubles the loss protection to the GSEs. This is huge. And we can do this today, as I mentioned, without legislation. So, if Congress decides to do comprehensive reform, and again, sort of going back to those challenges that we face as we look at how to reform the system, this serves as a proof of concept that private capital exists, that it can take this mortgage credit on. Another challenge that could be checked off with doing this proposal is a transition. You have to have some way to transition from the current system to something that's to moving to more private capital, and this could serve as a transition. And if the GSEs stay in their sort of status quo or some iteration of the status quo, at least you're pulling more credit risk away from the GSEs in a real meaningful way.
Great. Thank you, Lindsay. So Lindsay and Stan represent what's going on at the front end, but as one of our earlier slides showed, for the credit risk transfers that have been done now, over 50% actually being financed by asset managers. So Brian, let me turn to you and ask, so what is the asset management view broadly on credit risk transfers, the structures it used to date, and some of the outlook?
Sure. Yeah, no, I think hearing these comments, the first thing I'd like to add to Congressman Royce here is the good news is that there's demand for this type of risk out there. You talk about, how do you quantify that? Back up the story here about 5 or 6 years, and you had a $2.6 trillion non-agency RMBS market. That's the jumbo mortgages that were too big for Fannie and Freddie, the Alt-A, and the dreaded subprime mortgages. And obviously, we went through a dislocation. Prices went from 100 cents on the dollar down to 20 cents on the dollar, lots of losses, et cetera. But what emerged from that was what turned out to be, over the next 3 or 4 years, was one of the best buying opportunities, in the capital markets. And so what happened was asset managers, hedge funds, insurance companies, they basically put together these infrastructure. A lot of them previously did not have the expertise to effectively price this risk. They put together this infrastructure to then go buy this asset class. And I would estimate somewhere between, when that asset class had declined to a size of about $1 to $1.5 trillion, we had seen stabilization and a real proof that there was enough private investors out there willing to put about $1 trillion of market value risk on their respective books. And so the point in Stacker Cass is that, while that transition was going on, had that program been launched in 2011 or 12, it may not have really gone very well. But as that asset class has declined down to about a $600 billion asset class, the legacy asset class, now you've got this infrastructure built. It's hungry. It was looking for taking private housing risk, and all of a sudden comes Cass and Stacker. And at this point, and while we've had many different iterations of transferring this credit risk, it's the largest one to date. There's been 30 deals. And I think it's about a $25 billion market value, and so it's growing. Challenges right now for Stacker Cass, but I think they are something that they can be overcome. First of all, when you're investing in Stacker Cass, let's kind of call it what it is. You're basically making a kind of a broad beta play. Like the question, if you're going to invest way at the bottoms of these capital structures, is U.S. housing going to go down, and are defaults going to pick up nationally, or are they not? And that's effectively the decision you're trying to make. And you make the decision where you're getting paid appropriately to be invested in there. Whereas in the old asset classes, you have modifications to try to figure out advancing rates, liability, loan putback liability, all these different factors that come into play. And so it's much more of a beta play. You have limited investor participation. We talked about the REITs. I think it's bad income, and REITs only can have 25% of their assets in an area that produces that bad income. Insurance companies have been really handcuffed. The NAIC ratings, basically the capital ratings that they have to, the capital they have to hold to invest in Stacker Cass, it's more prohibitive than if they were investing in the legacy asset class. And so when they're making that decision, the economics still push them toward the legacy. And so if that changes over time, we could see that them transition towards Stacker Cass. There's a time element. No one likes to say it. We're impatient people. But over time, as 30 becomes 60, becomes 100 billion, you'll expand the investor set. And we saw the split of investors, 50%, roughly 50-50 hedge funds and asset managers. I can tell you that the problem with the Stacker Cass, and one of the complaints, is that the senior bonds in that capital structure that pay you, investment grade rating, that pay you LIBOR plus 150 to 175 basis points, decent liquidity, fairly stable prices, wide array of investors, the breadth is quite large. When you go down the capital structure, non-investment grade securities, or even Fannie and Freddie have started to sell the equity, 100 investors in reality becomes about 5 or 6. A few hedge funds, a few money managers, and in times like January and early February, when you get that type of volatility in the market, Wall Street basically pulls back, right? And so we have a Wall Street community that's been changed in the way they can execute risk, Dodd-Frank, Volcker, et cetera, Basel requirements, capital requirements. And so there are ways, I think, to tinker with the dealer community and how they can provide liquidity. I think there's ways to tinker with kind of to how to support Stacker Cass and kind of multi-standard deviation market events. But maybe what I'll finish and let other people jump in here is that I think Whether it's stacker cash, which has been the largest transmission mechanism, or whether it's the other deals from MI or PennyMac or other or banks that have done similar types of transactions. I think the very important point that I'd like to tell through the congressman here to Washington is that diversity is extremely important. Private capital can price this risk in most market environments, but private capital can be irrational. Private capital can require, there may not be a price. And so while stacker cash may be growing and becoming more vibrant, we're still going to need this path, and we want to diversify our sources of credit risk. But make no mistake, when you add up all the different lines we can put together, there's plenty of appetite out there to take that risk.
Yeah, and that's really helpful, Brian, because when all of this mortgage credit risk was housed on two balance sheets, Fannie and Freddie, this was a recipe for systemic risk, and we realize it's systemic risk. And your point is, by having this diversity of execution and diversity of sources of capital, we're really spreading that risk and removing the systemic element, even if the U.S. economy did go through another cycle of downturn in house prices. Well, let's build on your comments a little bit further, because we've told a happy story so far about credit risk transfer, but there's three areas of concern that have been that are frequently identified with the future development of this market. That is, should lenders have some kind of skin in the game? Should they retain some portion, some economic interest in these credit risk transfer deals? Will small lenders be able to access the secondary market as we move towards this? And then finally, will there be, this is, Brian, what you were getting at, will there be sufficient and permanent participation by investors to ensure liquidity in the mortgage credit market through the business cycle? Well, let's take the first two together, and we'll come back to the last one. So skin in the game. The Dodd-Frank risk retention requirements for asset-backed securitization. Basically, the regulators wrote an exception to the rule that swallowed the rule. So we don't have much risk retention in mortgage. But does that matter, or are investors going to be more concerned in just the disclosure and transparency of this market? And what about small lender access? How are we going to keep them involved here? So Stan, let me start with you.
So in our structure, because we do primarily serve the small lender and mid-sized lenders, and there's other issues involved in the capital required to originate mortgages. One of the most significant ones being the investment in the mortgage servicing rights. So capital is, I think, scarce for originators, and I think it matters most if those that are involved in it in the process and have capital can align their interests with the quality of the mortgages. And part of the way that our operation works is that we're diligencing, and because we think that the investment returns are appropriate and adequate, it will drive capital to us in our structure for those that appreciate that alignment. And if there's other less aligned in structures like a stacker and a CAS, because it's a reference pool of loans, it doesn't necessarily mean that the servicers or the originators are aligned, and it's not capital efficient because of the tax structure of stacker and CAS. Is really a debt, is like more of a derivative than it is actual cash flows coming from the mortgage structure, which ours is. So I think it is important to the ultimate investor in credit risk that there's alignment. Mm-hmm. I think the market can make up its mind. If they appreciate our structure, they can invest through the REIT, or they could buy our CRT bonds. If they want reference pools, they can do that. But I do think aligning interests is an important part of it for someone in the chain. It's not for the small originator who is going to rely on, or the market's going to rely on somebody else doing the diligence around it. But I think for large aggregators that are participating with basically the utilities of Fannie and Freddie to have aligned interests, I think is a positive for the market. I just think that comes with a very important ingredient, and that is that the return structure has to be appropriate. And that, so it's, when people say they ought to have capital aligned, it's not capital aligned to produce what is an insufficient return to attract capital.
Sure. Lindsay.
Well, and my comments are going to probably be a little bit more philosophical, but I think, if you're going to have the government as part of the system, whether it's a utility, whether it's a GSE, or another form that's supporting it, then you've got to have some kind of access point for smaller lenders. And you've seen various proposals that try to sort of accommodate for smaller lenders. I think they will have access at the end of the day. I mean, they'll have either through correspondence. But the other thing that I want to mention is, I think when we think about small lender access, we have to think beyond just the secondary market and the cash window, which are very important. I think that small lenders also need access to other features of the system, like credit risk transfer. I mean, the vast majority, the universe of players that have access to the back-end credit risk transfer deals right now it's very limited. It's sort of the biggest players. And we talked about sort of the origination and the growth of the CRT market, and the GSEs initially were really moving large portions of unexpected risk off their balance sheets. And they were testing the water. It was very much so an experimentation phase. And they had very few players that they were doing these transactions with. We've had 3.5+ years of that. And I think as we move forward, I mean, the GSEs are much better at doing these transactions. It's become much more part of their routine. But I think that we need to start focusing on transactions that are not just scalable and repeatable, but also that meet some of these broader objectives, like smaller lender access. How this gets done does matter. So making sure that smaller lenders have access, making sure that there's pricing transparency as part of these transactions, I think that that's really important. And so one of the concepts that USMI and a number of other stakeholders have really promoted is the concept of front-end risk transfer. Since 2012, the GSEs have done, and there's a pie chart that we can show if we want to, they have done roughly $3 trillion and purchased roughly $3 trillion in mortgages, of which about 20% of those, or about $840 billion, have been part of the expanded risk share. It's important to note that less than 1% of the total volume of the risk has actually been transferred off their balance sheets, or roughly 3 to 4% of the reference pool. It's significant. I think it's also really important and a significant milestone that in the 2016 scorecard, they noted that they're going to do 90% of UPB as part of that expanded risk share program. That is significant. But the vast majority of these transactions were all done on the back end. USMI and other stakeholders have said, we really want to see more done on the front end. USMI members, we actually have done both. We've done back end transactions. And we're supportive of both. But we think that there's some broader policy objectives that we can achieve on the front end, pricing transparency being one. And that's, I think for everybody on this panel, that's incredibly important. If we're going to, whether the current system stays in place or whether we actually move to a new system, having more transparency around what the credit is and how they're pricing that is going to be really critical going forward. If there's a borrower benefit, that could be realized if you had front-end risk transfer, where it's a competitive process. So that's something that we're really keenly focused on. And sort of to the second point, there's another chart. I like pictures. Just in terms of the staying power of these different credit risk transfer partners, I agree with Brian entirely. You've got to have a variety of different structures and a variety of different credit risk transfer partners. But how this gets done matters. And it's really, from a policy and a market objective sort of perspective, it's important to know that mortgage insurance has consistently been available as a credit enhancement option to the GSEs through all economic cycles. We talked a little bit about, when market volatility occurs, we've seen that recently when returns aren't as great. Some of these transactions are not going to be as good. And capital market structures have advantages, at certain times. But when the returns aren't there, when they're unable to sort of be there, you need entity-based capital. that's dedicated to the housing finance system, that's going to be there in those times, and it's going to have the capital to back that up. So that's something that we think is very important going forward.
Good. Thank you, Lindsay. So Congressman Royce, concerns that you see, whether it's skin in the game or alignment with between the originators and the credit risk holders, small lenders, what's your thoughts on some of these
Well, I think you want to have that alignment, and you want to have a bar, but you don't want to have the bar so high that you don't deepen and broaden the market and the participation. And per the issue that you raised with respect to how you get that additional participation, let's say the community bank level or mid-sized banks, regional banks, if you allowed the Federal Home Loan Bank to play a role here, pooling, or as the aggregator
Right.
here, they don't have to hold the risk, but you could create a vehicle. But the bottom line is this: you've got to deepen mortgage insurance. You have to probably legislatively address the issue you raised earlier, the 40 Act, and some of the tax consequences with respect to REITs. Your objective at the end of the day is to look at a situation where right now you have $750 billion of credit risk that has been transferred, but it is still a $5 trillion problem in terms of what sits on the books, either guaranteed or in the mortgage portfolios of the GSEs. So to do that, you need an all-of-the-above strategy. Yeah. And you also need a strategy where some of it has to be legislative. Now, I'd feel a lot more confident if Ed DeMarco was making the decisions in terms of how quickly to open up and spread the credit transfer, the credit risk transfer. But I think because of the views over at Treasury, as you saw today in your interview with the Treasury Secretary, and the views of members on both sides of the aisle, there is this growing sense that now is the time for us to push the process forward, not wait. And so I think the time is right to deepen the participation of private capital into this market.
Thank you. Brian?
Yeah, look, all else equal, skin in the game makes sense, right? I mean, but let me give you the other side of that from an investor standpoint, which is, first of all, the skin in the game that an originator might have or a bank might have in a securitization. There may be other aspects of the transaction, of the origination process, that may make that skin in the game not as high as it looks, right? Origination fees, the value of the servicing rights, et cetera. What I would prefer to have, if I had clarity as an investor, I'll take the leap and speak for the investment community. If I'm underwriting credit risk and I have confidence that the loan tape, think of an Excel spreadsheet with thousands of rows here with all the different loans and all the different aspects and the credit scores and the location and all these things. If I had confidence that all that information was accurate and done in the same standards across the board, if I had confidence that it was going to be serviced in the right way, if I had confidence in the way the mechanics of the deal were going to be overseen by the trustee or a deal agent or whatever, if I had confidence in that, I would far choose that path. Let me underwrite the transaction. Let me price the credit risk. If there's skin in the game, I can price that too, but I'm certainly willing to price the deal if I have that, even without skin in the game. And I also think that supports the smaller originators who don't necessarily have the pocketbook to write the check. If they don't have to write the check, or it's a much smaller check, but everybody's held to the same standards in terms of the information provided to the investment community, that's the kind of the new world that I would prefer as an investor.
Yeah, that's really helpful. And at the very start of our conversation, we touched briefly on the data standardization and disclosure work. I mean, interestingly enough, $5 trillion of GSE mortgage-backed securities that have been trading for years, but there has not been any loan level disclosures regarding the actual underlying individual loans there, and moving to a system that provides that to investors, especially if you're asking investors to bear that credit risk, is important. Well, our time's starting to run down a little bit, and we focused a lot on the conforming conventional market of Fannie and Freddie, but let's take a few minutes on the private label market. What do you all see as key things that went wrong in the private label market leading up to the crisis, some of these issues still need to be fixed, some of getting worked on. What do you see as being helpful in getting this going? And comments on that. Brian, why don't we start with you?
Yeah, look, it was the Wild West of mortgage origination. It became the Wild West of distressed pricing and refinance programs and modification and all this. And there was a lot of losses and gains. And long story short, we all have a lot of scar tissue, right, from what we went through. But I'll tell you, from my perspective, when I see Argentina borrow $15-16 billion at 7%, with another $45 billion waiting to lend to them, it tells me that in this kind of income-starved world, investors are willing to take that risk. So I do not believe that investors are still so scarred that they won't buy the new jumbo or Alt-A market. I believe they're ready and willing. I think what needs to be tweaked and incentivized is what we're doing with the banks. I still think the way the Basel III and I think Basel IV language reads is that it's still somewhat more advantageous for them to hold loans versus securitization. I think if you're Jamie Dimon and you're still writing checks to attorney generals and the SEC and this and that, and you've got marginal economics one way or the other, you're going to lean toward the loans as opposed to the securitizations and try to avoid that potential liability. And also, from a buyer's perspective, the banks were big buyers of non-agency securitizations, and right now the high-quality liquidity test that they have to meet, also with regards to Basel, it pushes them away from buying even the finest quality non-agency RMBS. So it's not a insurance asset manager a lack of demand for this type of paper. It's there. It's tweaks we need to make, I think, on the banking side, capital, and liquidity ratios that I think will really kind of promote this. And I'll add into that shrinking the GSE format. I think we can kind of adjust their underwriting matrix to shrink it a bit, push more loans outside of their box, and give more loan supply to the market.
Right. And that raises the issue of the conforming loan limit as well, as to whether that should be frozen or gradually brought down or whatever. Congressman Royce.
Well, let me just make an observation that some of what we went through in terms of looking at the way in which people got burned in the market was the result of really two things, other factors as well, but one certainly was a situation where the GSEs themselves were making a market. They were buying a lot of the subprime. They were holding it in their portfolios, and that race to an ever higher yield that was going on at the time, where 30% of all the transactions were people flipping homes, and where our attempts to give the regulatory community the ability to regulate for systemic risk were thwarted. I think we've learned a lot coming out of that. The question now also, though, goes to Hernando de Soto, the Peruvian economist, point about opaque markets. With technology as it is today, it should be possible to follow the attributes, especially if we get this standardization, the attributes of these individual loans, so that the market can better price risk, better understand that risk, rather than have the opaque situation we were in. And this also goes to the standardization of other issues, reps and warrants, the common securitization platform, and making certain that's available to everyone. The standardization becomes very important moving forward.
Right, great. Stan, thoughts on the private label market?
Going to be a long time till we have a really active private label market for jumbo mortgages, and really associated with the fact that the market demand at the moment is being met by Fannie and Freddie because the loan limits are high enough to really take out a big part of the need, and the banks are trying to also invest in higher balance mortgages. At the same time, the actual regulatory requirements around QM and the creation of mortgages that are eligible for a security, and then combined with that, the underwriting of those securitizations makes it really not economical. No one who's participated in creating the initial jumbo private label securities made money at doing that. It was trying to restart that market, and I think it was very, very frustrating with the advent then of QM, and so it seems a very long way off that we will have a private label securities market, particularly until we reduce the box in which goes through Fannie and Freddie. And I think first step to doing that is credit risk transfer, that we have to have uniform information and the ability to understand and measure credit. And that's, I think, in any of the structures that we're talking about, I would totally agree. We need lots of transparency. And the good thing is that that information exists. And what's taken place in the industry over the last several years is that the quality of the underlying information is just much more reliable and better. So I think those things are within our grasp. But private label is just a step behind getting credit risk off first. And I think that, thematically for me, the evolution of this market is really what we have to pay attention to, because it's, and the way that it's happening, it's very important that we start to move in this direction and we do things like credit risk transfer, and that will lead to greater trust in the information and the servicing ability. That will lead to private label securitization, but it's not going to happen. It's not an overnight issue. It's a transition.
Yeah, very good. Lindsay, what role can mortgage insurers play in restarting the private label security market at whatever pace that may happen?
Well, a couple of considerations. I mean, I think one thing that would definitely benefit the PLS market, and I think that would give investors some relief, is some kind of down payment requirement, whether that's 20% or some kind of standard cover. And beyond that, I would really say, we're going to do our part, and I think that we would be willing to participate, going forward if there is standardization, if there's more transparency, to sort of Stan's point. I think that's sort of a key point, and I know that all of us would agree. Transparency in terms of pricing, the way that the government's pricing, will just help inform market participants, and that would definitely inform a PLS market. So I think that those are really kind of key things. Housing finance reform is obviously a very key component. I think that would go a long way in terms of reducing this uncertainty for that market. So we're going to be there. Private mortgage insurance would welcome the opportunity to participate more in the private label mortgage securitization market. But I think that some of these steps have to be in place before we're really able to sort of analyze and take on that credit risk.
Okay, very good. Thank you.
Yeah, I just want to make one other important distinction in the case of a REIT in these activities, is that we generally make this investment available to the general public as opposed to just being held at hedge funds or really large investors. And I think that's an important part of the way the market develops, to make returns and accessible to the general public. And I think that's what a REIT does.
Right, and how markets should work. Congressman, final comment?
Well, the final comment would be that there are a number of vehicles now that have been introduced in the House and the Senate. And clearly, I think we're moving at an accelerated pace towards this consensus view that this is the step to bring private capital back in, and that there is, I think, quite an appetite out there for additional private capital to come back in, but there's some legislative fixes that are going to be required as well. That in addition to the push that FHFA is getting from the Treasury Department, you also now see members of the House and Senate trying to push them along, but I think we're going to have a vehicle, a legislative vehicle, in order to accelerate that momentum.
All right, thank you, Congressman. I'd like to thank the panelists for their contribution to a terrific discussion of bringing private capital back to mortgage credit. Thank all of you for being with us this past hour. Thanks very much, everybody.